Hello and welcome to a Wealth of Advice market update on the 13th of December 2021. In this week's update, we're going to look at what's been happening in the markets over the last few weeks. Been quite a bit of volatility again, however markets have generally been positive. And we're going to look at what major news stories have been happening in the UK and around the world and how that's been affecting markets or not, as the case seems to be. The emergence of the Omicron variant has brought about stricter restrictions across the UK and into Europe. Personally, I'm quite confused as to why such extra restrictions are being imposed in the manner that they are, and why government and politicians are trying to scare the population with everything that's going on. Boris's announcement last night that they're going to try and get 1 million people a day get their booster vaccine by the end of the year seems crazy to me, when you're going to push waiting lists and other things back within the NHS. But let's not beat around the bush. The real reason why I believe he is doing this is because they're so scared that the NHS could be overrun if there is an uptick in the amount of people who are going to hospital in January with COVID. So that's probably the main reasons why they're doing it. People might wonder, therefore, with all this negative news, why markets haven't crashed in the last few weeks. Well, markets in general are doing okay because companies are doing well. Business is good for most companies up and down the country. The biggest problem most companies face right now is still recruiting the right people into the right roles, and as I say, that will continue to be a problem the world over, probably for the next 12-18 months as we emerge from what COVID brought to us. In our last couple of updates, we discussed how rising inflation was a potential problem for world markets. We've kind of gone past that news story a little bit now. That's not to say inflation isn't there, it is, but markets aren't certainly being as volatile as a result of that. The Bank of England and the US Federal Reserve have said they're going to forecast to raise interest rates in 2022 to help dampen rising inflation. But a statistic we saw quoted a few weeks ago was quite interesting. If the UK raises interest rates by 1%, it will cost the UK an extra £20 billion a year to service its own debt. So given that national insurance went up by 1% recently, that was going to raise an extra 20 billion over 3 years for the Treasury. It's hard to believe that interest rates in the UK are going to go by very much, because it would cripple the government with the amount of debt that we actually have. The same thing would apply in the US. So while interest rates may go up, it's going to be 0.1, 0.15% every time. Geopolitical tensions are rising across the world. The Beijing Winter Olympics are going to be boycotted by the UK, US and Australia. There's also big tensions arising between Russia and the Ukraine. Again, when we talk about what news stories seem to be the main headlines on BBC, Sky, these sorts of news outlets, I'm quite surprised as to why this is not more prominent. Apparently, Russia has got its tanks virtually bordering the whole of Ukraine, ready to go. So that could cause big problems in the short term from a volatility point of view if Russia does decide to invade at some point. So we've got to keep a close eye on that. But despite all that, there is definite reasons for optimism in the market outlook for 2022. All the main fund managers that we're speaking to are expecting markets to rise during 2022. There's some who are a lot more optimistic than others, and we'll come on to that now. So now we come to that part of the presentation where we look at how market indices have performed. The first graph that you can see now looks at the performance through 2021. As you can see, the green line at the top, things have reverted back to normal in the second half of this year, where the US market is again starting to dominate. The FTSE 100, which is the blue line at the bottom, has had a very good year. It's up 17.57% since January the 1st up to December the 10th. You can see the news of the Omicron variant, which came through at the end of November, did cause a little bit of a market dip. That was also around about the time when we were talking about high inflation stories and other things like that. So there was a bit of volatility there. Markets weren't doing so well. But as we've gotten into December, things have recovered and picked up nicely. So as we end the year, US markets up over 30%. The MSCI World Index is up 24.5%. And the UK FTSE 100 is up 17.5%. So it's been a very good year for the major indices recorded. We now look at the longer term graph when we look at the market indices performance over the last 5 years. And as you can see there, over 5 years, if you'd been invested and you'd disappeared to another planet somewhere and you've just come back down, you wouldn't even be aware that COVID's happened from the point of view. I mean, the US market there is up 112% over 5 years. The MSCI World Index up 89%. The FTSE 100 only up 28% over 5 years. But again, the excuses for the FTSE 100 is it's dominated by certain types of stocks which haven't done well, as well as all the Brexit story and everything that went with that. The US and the MSCI World Index has been buoyed by those huge technology companies just absolutely booming over that period. So anyone who's invested for the long term, as you can see, those ups and downs, those peaks and troughs, it always results over the longer term that good growth will come through. So as we approach the end of 2021 and we look into 2022 and what might lie ahead, we have been speaking with a lot more fund managers over the last few weeks, so I'm now going to give a bit more of an in-depth update on where we think things might go in the coming 12 months. The first update we're going to discuss a lot is from Legal & General investment fund managers, who we have around about £45 million of clients' money invested with as part of our Wealth of Advice risk score portfolios. We spoke with Justin, who is head of the Legal & General multi-index funds there, and he explained that he believes the outlook for 2022 remains positive, but they do not expect growth to be as strong as 2021. In my opinion, that would be a very sensible thing to say, shall we say, because 2021 really did bounce back quite strongly from the problems of 2020. Obviously the vaccine news came through, we had the Brexit deal agreed at the beginning of the year, so I think it is common sense to say that 2022 won't be as strong, but it still will be as positive. The Bank of England, they expect them to increase interest rates slightly, as I say, on a monthly or quarterly basis to try and combat inflation, but they don't expect interest rates to get above 1% anytime soon. They believe inflation is temporarily high. It will persist as we go into the new year. It will continue to cause market volatility, but then will fall away again. Inflation is based on a 12-month calculation from where prices were last year to today. So obviously last year's prices during 2020 of lots of items went down as we weren't consuming as much. So therefore the high inflation figures we saw recently were always going to be there. China was one of the main drivers of global economic growth over the last decade, but Chinese growth has slowed to around 4% a year, which is the lowest for the last 30 years. That will have an effect on global growth. But President Xi believes that a common prosperity drive will see somewhat lower growth in the short term is better for their equality and better for growth over the longer term. Let's hope he's right, because if China was to have a big blip and a big fall off, that could have a negative effect for the rest of world markets. So we'll just have to wait and see on that. But again, general positive update from Legal & General fund managers, so we're happy with that. The next fund manager we spoke to was Janus Henderson. Janus Henderson we use quite a bit for investing in corporate bonds and government bonds. We've got around about £10 million of clients' money invested in their funds. They're quite cautious in their outlook, but as I say, as bond fund managers, they're always looking for what opportunities exist without incurring too much risk for the clients. They believe that the 2022 outlook is also going to be positive. One of the big concerns that Janus Henderson had was in 2013 when the US government stopped buying its own bonds. Bond markets didn't react nicely to that, and it was referred to at the time as a taper tantrum because they were tapering in how many bonds they were actually buying on a monthly basis. So the US is planning to do that again next year by reducing this impetus into the markets by buying its own bonds, but they do not believe another taper tantrum will happen because the Federal Reserve have been more upfront this time about it's being communicated to the markets well in advance, and therefore bond markets shouldn't see a big shock on that. So again, we're not expecting a negative year for bonds next year. When they were talking about the Omicron variant, they said real world data will actually take a few weeks to interpret and come through, but the early evidence coming from South Africa suggests that low severity of what the virus is doing to people who contact that variant means that it shouldn't disrupt markets too much. But again, they're just going to keep an open mind on that, an open eye on that. But overall, from the bond market point of view, positive 2022 may lie ahead. So both the Legal & General Fund and the Janus Henderson funds we mentioned there are part of the Wealth of Advice risk score portfolios. The next graph you can see on the screen shows the performance of those portfolios during 2021. And as you can see, as we mentioned on the previous graph there, things were starting to look a little bit iffy as we got towards the end of November into December when markets were going down. Some of the higher risk portfolios, the purple line at the top there, which is risk score 5, which I should say very few clients are in there. That's almost 100% in the stock market. That came down quite heavily, but it's recovered quite quickly. The majority of clients have risk score 3, and we're very happy that during 2021 that portfolio is up over 10%. Wouldn't it be great if I could promise to clients 10% growth every year? I can't, I won't, but I do think 2022 is going to be a positive year for these sort of portfolios. The next chart you can see is the one which a lot of clients have expressed interest in seeing, because it goes back to when COVID first came to the world, or when markets first realised it was happening. We always put the date in of the 18th of February, and what this graph shows, if you had a notional £100,000 invested on the 18th of February 2020, what it's worth now if you were invested in one of these two portfolios. The more cautious portfolio is back up to £112,488. The risk score 3, which is a bit more speculative, roughly 60% in the stock market, is above 115,000. So again, like I said earlier in the presentation, if you'd been on another planet for the last 2 years and you look at your investment returns, 100,000 up to 115,000 over what, a 20-month period, you're not going to be too disappointed with that. That cliff edge that we fell off March 2020 is now a thing of the past, and as we move forward, yes, as you can see from the recent ups and downs, volatility still exists, but the general direction is in the positive direction. When we look at how the various portfolios that we invest clients into are invested, we call this asset allocation, i.e. how much of your fund are we putting into different areas around the world and in which different markets. The graphs or the charts you can see in front of you there break down those different percentages. Right now, we've got no plans to change any of that. We made a change to these a few months ago. We've got no plans to change anything as we go into the new year. And overall, we're very happy with all of the funds we have invested in those portfolios and what those portfolios and funds should do in the coming 12 months. The next fund manager we're focusing on is Roy London. We spoke with Trevor Greetham recently, who's head of multi-asset portfolios down at Roy London. Again, we've got around about, I think it's about £50 million of clients' money invested in the various Roy London portfolios, and he's given us an update on what his views are. Again, like the Legal and General guy, pretty similar stuff. He was saying global growth is slowing after the big bounce back as economies reopened. Business confidence is actually lower right now as the economic data that's coming through is below expectations for the first time in months. But that said, growth should still be relatively strong next year, just not as strong as it was after the initial recovery. Roy London think inflation will start to come down, and that, as I say, when we talk to these fund managers, we're starting to see a consistent view on inflation. Yes, everyone was worried about it September, October, then we got it in November, but then things have started to settle a bit, so that's good. Activity levels in consumption, manufacturing, housing construction are back to pre-COVID levels in the US. Definite positive. The UK and the rest of the world are not far off pre-COVID levels. I think it was JP Morgan in the US said as we get into the middle of 2022, the whole of the world will be out of the COVID conditions from an economic point of view. And what Roy London is saying there, it agrees with that we're not that far off pre-COVID levels as well. Vaccination rates across the world are very positive. Countries that were lagging behind, such as Japan, are catching up, and that's positive. Boris and his announcement last night is now recommending people in our country are going for their booster jabs. I know that's happening in the US as well. So if we keep this up, then the world will become, obviously from an economic point of view, a much better place next year and beyond. Mentioned earlier about the wealth of advice model portfolios and its asset allocation. Now looking at the Roy London portfolios and their tactical positioning, they were quite strong and overweight in equities on the back of the vaccine news that came through in November 2020. That helped performance through 2020. So again, they're quite happy with how their portfolios are positioned. They're very positive on the outlook for US, UK and Japan. They're concerned about emerging markets, so they're reducing the amount that they have there as China's growth rates may be slowed down to what we would call normal levels. 4% a year is actually something the UK has dreamt of for years and years, but China saying it's going to come down to 4% may cause a bit of a headwind in emerging markets, so they'll be looking at those particular areas. We now look at the performance of the Roy London portfolios through 2021. The line at the top there is the highest risk one, the government portfolio 7, which has the highest exposure to the stock market. That's up 18.38% so far during 2021. Again, the majority of our clients who invest in the Roy London portfolios are either in B or C, which is either the government portfolio 5, which is for clients pre-retirement. That's up 14% so far this year. And the government retirement income portfolio, mainly for those clients who are in drawdown, that's up 11% this year, a little bit more cautious. The very, very cautious one at the bottom, Royal London Governed Retirement Income Portfolio 3, that one's lagging behind, and that's because that one's had more in government bonds and corporate bonds this year, which hasn't done as well as stock market based investments. That's for the more cautious client, which is why those people who are in that portfolio have it. It's what they sort of require given their attitude to risk. But overall, like all the portfolios we've gone through, we're very happy with the performance of these. Again, any clients watching this wondering why am I in this portfolio or not that one, it's all down to what your overall objectives are, what your long-term plans are, what your investment funds are. And as I say, right now, we don't believe anyone needs to make any major changes to these. It would have been recommended by now if we did feel anything needed a change. Now looking at the Royal London portfolios over the longer term, again, as I said on the previous graphs, being invested in any portfolio for 5 years, that COVID cliff edge just seems like it never happened. If you lay a ruler across that now, that horrific dip that goes down, we're now well past that, and as I say, growth is now coming well above previous pre-COVID levels, which is good to see. If you'd invested £100,000 in the Royal London portfolios on that notional date in February 2020, again, you can see similar to the Wealth of Advice portfolios that we mentioned on previous graphs, we're now well above where we were. The higher risk portfolios obviously doing much better than the low risk portfolios, but that's just the nature of how you invest funds for the long run. So again, nothing to be concerned about with any of these portfolios, and hopefully 2022 is a positive year, and that 2020 cliff edge just becomes a further thing in the past. So thanks again for listening to Wealth of Advice Market Update. This is the last one we're doing for 2021. Wish you all to have a great Christmas and all the best for 2022. Our offices will close 5 p.m. on the 23rd of December. We'll reopen 9 o'clock on the 4th of January. The Monday the 3rd is a bank holiday, so we're opening Tuesday the 4th. As ever, if you need anything from us during those times, send us an email, send text messages, leave voicemails. We will get back to you. Hopefully there's nothing major happens in anyone's lives where they do need to get in touch during those 2 weeks, but as usual, if you need us, we will get back in touch. So without further ado, that's another wrap for 2021.